Well, traders are bracing for a volatile month as Wall Street looks to a potential 75 basis point rate hike, both in the U.S. and in Europe. Now, research platform Quant is using alternative methods to measure market volatility as global factors increasingly weigh on U.S. markets. Joining us now is Hugh Roberts, Quant Insight Head of Analytics. Hugh, it's good to talk to you today. Before we get into what exactly QI measures, let's talk about what viewers typically think as the fear gauge. We talk about the VIX a lot. Why do we need an alternative to that?
Well, the easiest answer for that, or probably the most painful answer for investors, is typically the negative carry. The shape of the forward futures curve for VIX means that being long VIX futures and sitting around waiting to time the exact moment where we get risk off, and you suddenly see a sharp spike in VIX, you can bleed carry, and that makes it an expensive kind of protection. So an alternative fear gauge really is one way to try and negate that, to make it a more efficient carry trade for people. But also, it's just no market is completely infallible, and having a plan B is no bad thing in financial markets.
Certainly a plan B could be needed right now. QI Volatility Index is what you're pointing to. What exactly does that measure, and how does that give better insight in terms of the moves globally?
So Quant Insight's all about macro, and we're all about regimes. Markets typically move in cycles. Most of the time, macro fundamentals drive equity markets, currency markets, bond markets, but there are other drivers out there. There are times when a market's in a clear trend, and you can see all the CTAs and the trend-following strategies will push a market higher because there's a clear uptrend on the charts. There are times, if you're a stock picker and it's earnings season, when you'll focus on company fundamentals and those kind of more micro, or what's known as idiosyncratic news. But most of the time it's about macro. But what's critical and what investors do all the time is they are trying to monitor these regime changes as the market changes from being driven by the Fed or macro narratives like inflation to periods where you should be chart watching. So that's the background to our vol indicator, trying to capture these regime shifts. And to answer your question more directly, what we've done is we look at macro's ability to explain price action in 6 key global benchmarks, a couple of equity indices, S&P 500 and Euro Stoxx 600, a couple of major FX crosses, dollar yen and euro dollar, and then 10-year yields in US and Europe. And what our index measures are points in time when macro is doing a good job of explaining price action, and points in time when macro can't explain price action. And the key point here is that when macro fundamentals are not driving global capital markets, then markets are probably being driven by positioning, by sentiment, but by factors that are incredibly more transient and typically more volatile. So as our vol index moves around, you can see we're moving from periods of stable macro fundamentals to less stable positioning, sentiment-driven markets. And that's really how our clients use the vol indicator.
So Hugh, let's break down some of those benchmarks that you highlighted, the euro dollar, the dollar yen, the 10-year yield. I mean, those are all, we have seen huge swings there within the last 24 hours or so. What does that tell you when you break it down through QI, your index? What does that tell you about where the market's headed?
So what we're doing, we do have valuation tools that can say, for example, the S&P 500 at the moment is currently half a standard deviation cheap. It is sold off slightly more aggressively than macro fundamentals warrant. But what the vol indicator does is not a valuation tool. It's looking at the ability of macro to explain price action and therefore say, well, when price action is not driven by macro, we are in these periods of probably positioning and sentiment driven. So really you have to distinguish between a valuation tool, which we can do, or just really trying to give people a heads up for when markets are potentially about to go through a bout of risk off and should really be thinking about their positioning and their sizing accordingly.